Are you looking for ways to maximize your investment portfolio? One important factor to consider when making an investment is a company's dividend policy. In this video, we will provide a guide to understanding dividend policy and how it can impact your investment decisions. Whether you're a seasoned investor or just starting out, this guide will give you the tools you need to make informed choices when it comes to dividend stocks. If you like this content, please remember to like and subscribe. A dividend policy is a set of guidelines made by a company's management on the payment of dividends to shareholders. It outlines how much of the company's earnings will be allocated towards dividend payments and how frequently these payments will be made. There are several types of dividend policies that companies can adopt, including 1. The constant dividend policy. This involves paying a fixed amount of dividend per share on a regular basis, regardless of earnings or financial condition. This policy is relatively rare and is typically used by mature companies with stable earnings. 2. A stable dividend policy. This involves paying a consistent dividend over time, usually based on a percentage of earnings. The goal of this policy is to provide investors with a predictable income stream while still allowing retained earnings for future growth. 3. An irregular dividend policy. This involves paying dividends on an unpredictable schedule, depending on the company's earnings and financial condition. This policy is typically used by companies in cyclical industries or those with inconsistent earnings. 4. A residual dividend policy. This policy involves paying dividends only after the company has met its investment and financing needs. It prioritizes reinvesting earnings back into the company for future growth over paying out dividends. 5. A hybrid dividend policy. This combines elements of each, such as paying a stable dividend with occasional special dividends, or adjusting the dividend payment based on the company's earnings and financial condition. Companies must consider several factors when determining their dividend policy. A company's financial health is a key consideration in determining its ability to pay dividends. A company with a strong financial position and healthy cash flow is more likely to pay regular dividends to shareholders. If a company expects to invest heavily in future growth opportunities, it may decide to retain earnings and reinvest them in the business rather than pay dividends to shareholders. Shareholders often have expectations about the level and stability of dividends. Management should consider these expectations when developing their dividend policy. Company management should consider the taxation impact of dividend payments for different types of shareholders. Further, companies must comply with legal and regulatory requirements related to dividend payments, including restrictions on the amount of dividends that can be paid out relative to earnings or profits. The dividend policy is an important factor for investors to consider for several reasons. 1. It provides insight into the financial health of the company. A company's ability to pay and increase dividends over time can be an indication of its financial strength and stability. A company that consistently pays dividends can be seen as a financially stable and profitable company. 2. It helps to evaluate potential returns. Dividend payments provide an income stream to investors, which can be reinvested or used as a source of passive income. Understanding a company's dividend policy can help investors estimate potential returns and evaluate whether a particular investment fits their objectives. 3. It can be an indicator of management's confidence in the company's future. When a company increases its dividend payout or maintains a consistent dividend policy, it can be interpreted as a sign that management is confident in the company's prospects. 4. It can help to assess risk. Companies that pay high dividends may be perceived as less risky because they are committed to distributing a portion of their profits to shareholders. However, high dividend payments may also indicate that the company has limited growth opportunities and may not be reinvesting enough capital back into the business. A company's dividend policy should balance the competing interests of different stakeholders, including shareholders, management, and creditors, while supporting the company's long-term financial health and growth objectives. By considering these key factors, companies can develop a dividend policy that best meets the needs of all stakeholders. Institutional investors, such as pension funds, hedge funds, and mutual funds, play an important role in shaping dividend policy. They often hold large blocks of shares and may have significant influence over the company's decision-making processes. Institutional investors typically have their own unique set of expectations and requirements when it comes to dividend payments. For example, pension funds may prioritize stable and predictable income streams to support their long-term obligations. In some cases, institutional investors may have specific requirements for dividend payments, such as a minimum dividend yield or a certain level of regularity and stability. This can create challenges for companies that are unable to meet these requirements, as it can lead to pressure from investors and potentially negative impacts on share price and investor confidence. Thank you for watching this video on understanding dividend policy. We hope that you now have a better understanding of what a dividend policy is, why it's important, and how to analyze it. If you found this video helpful, please consider liking and subscribing to our channel for more informative content on investing and personal finance. And don't forget to hit the notification bell to stay up to date with our latest videos. Remember, understanding dividend policy is just one aspect of making informed investment decisions. Keep learning, stay informed, and always do your due diligence before making any investment decisions. Thank you again for watching, and we'll see you in the next video.